All right, so let's dive into this Robinhood story. This one's a little wild. The app that everyone thinks of for trading stocks got in trouble with the CFTC. And get this, it's because they were letting people bet on the Super Bowl.
Yeah, you don't really think of Robinhood for, I don't know, Super Bowl bets.
Not at all. So for you, our listener, we're going to break down the whole thing. Why did the CFTC get involved? Were these bets even legal in the first place? Let's rewind a bit to October 2024. Robinhood actually launched contracts based on the U.S. presidential election.
Oh yeah, I remember that. And that was after a whole legal fight too. Kalshi, you know, that prediction market platform, they partnered with Robinhood for both the election bets and the Super Bowl ones. Well, they won a court case against the CFTC. The CFTC was trying to block those election markets.
So it seems like even back then, regulators were already kind of suspicious of this whole event-based trading thing.
For sure. And with the Super Bowl, it seems like that scrutiny just went into overdrive. So this time on February 4th, 2025, Robinhood rolls out this feature, letting users bet on who wins Super Bowl, LIX, Eagles versus the Chiefs.
But there's a catch, right? It wasn't open to just anyone.
Right. Only something like 1% of Robinhood users could actually access it. It's like they were just dipping their toes in, testing the waters before they went all in.
Yeah. But then on that same day, February 4th, the CFTC comes in and basically shuts it all down. Robinhood even tweeted that they had to suspend everything at the CFTC's request. Existing bets could be settled, but no new ones allowed.
Yeah, and the CFTC's statement was pretty strongly worded too. They said they would, quote, exercise its oversight authority to the fullest extent, end quote, to ensure, companies were playing by the rules for derivatives.
But they never actually said why they shut it down publicly, did they?
Nope, they kept the exact reason under wraps.
Which makes you wonder what it was about these bets that had them so worried.
Right. It looks like they're trying to figure out, do these event-based contracts, these Super Bowl ones specifically, do they fall under the existing rules for derivatives? Or do we need a whole new category for this stuff?
And this isn't just about Robinhood either, is it? Crypto.com and even Kalshi again. The CFTC is looking into them for their Super Bowl contracts too.
Exactly. It's a bigger trend for sure. Regulators are getting more and more uneasy about event-based trading, especially when it's tied to these massive events. The Super Bowl, everyone's watching that.
So the question is, why all the fuss? Why are regulators so wary of this type of trading? I think to really understand this, we need to dig into what derivatives actually are and why they can be so risky.
Yeah, that's a good point. A lot of people hear derivatives and they think back to 2008, the financial crisis. And, these Super Bowl bets might seem harmless on the surface, like just some fun for the big game. But they actually have some things in common with those really complicated financial instruments, the kind that helped cause that whole meltdown.
So for you, our listener, let's break it down. How can these simple bets on the Super Bowl be considered derivatives? And why are regulators so set on preventing another financial disaster? Okay, so we're talking about these Super Bowl bets. And now this term derivatives is being thrown around. I think for anyone listening who might not be super deep into finance, can we just unpack that a little? What exactly are derivatives? And how do these bets on the Super Bowl fit into that whole thing?
Yeah, of course. So at the most basic level, a derivative is basically like a contract, but its value is based on something else, some underlying asset. It's kind of like a side bet on something else happening.
I think I'm following. But how does that make a bet on the Super Bowl a derivative?
Let's say you bet that the Eagles will win. All right, so the value of your bet, it goes up or down based on whether they actually win.
Right.
So it's derived from the actual event itself. It's not like buying a stock where you own a part of a company, in this case. You're betting on an outcome.
So it's a betting on an outcome part that makes it a derivative.
Exactly. And, these derivatives, they can be structured in different ways. It could be like a binary option where you either win a fixed amount or you lose everything. Or it could be like a futures contract where the value goes up and down more dynamically as you get closer to the event. We don't know exactly how Robinhood structured the Super Bowl bets, but the point is they were tied to an event. And that's what puts them in that derivatives category.
Okay, that makes sense. But then why are regulators so concerned about derivatives?
Oh, sure.
Even if it's just for something like the Super Bowl? It seems pretty harmless. Didn't you mention something earlier about the 2008 financial crisis?
Yeah, I did. And that's really the key issue here. Look, derivatives can be useful. They can help manage risk. You can use them for speculation. But they can also get super complicated really fast. And if they're not properly understood or regulated, they can pose a huge risk to the whole financial system.
Are you saying there's a chance these Super Bowl bets could lead to something like another 2008?
Well, it's not that these specific bets would cause a financial collapse, but they show us a bigger concern that's out there. Remember, back in 2008, the housing market collapsed, and it was all these derivatives that were linked to those mortgages that really made things so much worse and turned it into a global disaster.
So regulators are worried about a domino effect.
Yeah, exactly. If you have these derivative markets that aren't regulated well or people don't understand them, it creates what's called systemic risk, meaning problems in one area can quickly spread and mess up the whole system. And since event-based trading is still pretty new, there's just a lot of uncertainty about how these markets will actually behave, especially as they grow larger and more interconnected.
It's like this tangled web that regulators are trying to untangle before it gets too out of control.
That's a great way to put it. I mean, the CFTC's job is to protect investors and to make sure the financial system is stable, so they have to be cautious, especially with these new products. That could cause so much disruption. They need to figure out, do our current regulations cover these new types of bets, or do we need to create completely new rules?
So it's not that they want to stop innovation. It's more about making sure that innovation happens responsibly, with the right safeguards in place.
Exactly. And this is where it gets tricky. You have platforms like Robinhood pushing the boundaries, creating these new and exciting products. But then you have regulators who are naturally more careful because they have to minimize risk and prevent another financial crisis. It's a delicate balance.
Yeah, it really is. So for you, our listener, this situation with Robinhood and the Super Bowl, it shows us this tension that exists in the financial world between innovation and regulation. Robinhood wants to offer these cool new products, and there are probably a lot of people who want to use them. But then the regulators come in, waving their red flags, saying, hold on a second, let's make sure we really understand what could happen here before this thing blows up.
Okay, so we talked about the risks, how things could, go really wrong, like back in 2008. But I'm sure there's another side to this whole thing. What about the good stuff? Are there any arguments in favor of these event-based markets?
Oh, absolutely. The people who support these markets, they say that these types of bets can actually help us, like understand risk better and even price risk more accurately, which they say would lead to, more efficient markets overall.
Okay, I'm listening. How does betting on the Super Bowl, or I guess any event really, how does that help us understand risk better? Think of it this way. When people can actually put their money on the line, it makes them want to do their research.
Right.
They're not just guessing randomly, they're going to analyze data. Think about all the different factors and try to make informed predictions.
So it's not just straight up gambling. There's actually some real thought and analysis involved.
Exactly. And when you have a bunch of people doing that, trying to figure things out, it can create a more accurate picture of how likely different outcomes are. This is what they call price discovery, basically the market as a whole, figuring out the true value of something.
So these event-based markets, they could give us insights that go beyond just who's going to win the Super Bowl.
For sure. Think about it. Businesses could use this information to make smarter decisions about inventory, marketing campaigns, even long-term investments. Investors could use it to hedge their bets, manage their portfolios better. It's all about taking information and turning it into insights that you can actually use.
So there's potential for these markets to become like powerful tools for decision-making, not just a place for people to gamble.
Absolutely, but we do have to remember, we're still in the early stages. We're still trying to figure out how these markets really work. And yeah, there are valid concerns about things like volatility, manipulation, and the need for strong regulations.
It's that back and forth we were talking about before, innovation pushing ahead and regulation trying to keep up.
Exactly. And at the end of the day, the future of this whole event-based trading thing, it's going to come down to finding the right balance between letting innovation happen and making sure we're managing the risks.
So for you, our listener, this whole Robinhood Super Bowl situation is just a small part of a much bigger story. Event-based trading is here, and it could totally change how we think about risk, predictions, even decision-making in all kinds of industries.
Yeah, and the big question is, are we going to jump in with both feet, or are we going to be a little more cautious? Because, there could be some real problems down the road. Only time will tell how this all plays out.
Well, that about wraps up our deep dive into Robinhood getting shut down for those Super Bowl bets and what it means for the future of finance.
It's a complicated issue. There are no easy answers. But, hopefully, this discussion has given you some things to think about.
As always, we encourage you to keep learning about this and form your own opinions. The world of finance is constantly changing. It's important to stay informed and have these conversations.